Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, PSU banks are definitely recovering and making highs of the day. Most of them, PNB, OBC, Canara Bank, the ones which have been beaten down the most. So they are making highs of the day or highs of the morning for now. But there's been quite a bit of selling, of course, that we have seen from FIIs. We have Rick Lacaille, Chief Investment Officer at State Street Global Advisors, and is responsible for all the investment management activity, who now joins us. Rick, good morning. Thanks a lot for talking to us. So your thoughts on India right now and the kind of underperformance that we have seen for our markets?
Yeah, I can't comment on the very short-term underperformance, but if you look at global economic conditions, they're pretty favorable. We think we're going to see good growth in 2018 from a global perspective, and that extends to India as well, obviously having had the low base effects from last year. But that doesn't mean we necessarily favor the equity market in India. I think when we're looking at equity markets, we favor certainly US and emerging markets, but India is often a little expensive, and I think that's the case now, where we're less enthusiastic within the emerging market context about India than we are about some other markets.
Okay. Thanks, Rick, for dropping by. Let's start then at the global end. We've had these shivers coming in because of potential tariff wars, and they're not looking like going away. You think this might, darken the picture for equities? If yes, which ones?
Yeah, I think the concern that we should have about equities overall is the sense the black cloud of protectionism. If we begin to have trade barriers emerging as a result of unilateral action by US, I think that can be damaging for economic growth and particularly for corporate profits. And although that may not extend specifically to India as being in the crosshairs, so to speak, I think it'll affect investor sentiment. So I think of all the risks that we're concerned about in the long run, that's probably the largest. I think inflation risk, certainly in the US, is a thing that's on many investors' minds. We don't think that's a significant longer-term concern, but we understand bond yields have backed up, and that, again, extends into the context of valuing emerging market assets.
Mm-hmm. So yeah, actually, if I can just extend on inflation, we just had a statement from Chris Wood, his usual greed and fear weekend release, where he says that the March inflation in the US could be high also because of the base effect, and that could, it comes out on April 11th, he says, and that can be a significant event for markets near term. Generally, are you pricing in 4 rate hikes from the Fed at all? And has the market priced that in? Will that be a worry?
I think what matters in the US is as much the number of hikes as the commentary that goes with it. I think the Fed under Janet Yellen has been very data-driven. We're expecting that to continue. And in a sense, we're all looking at the same data. So any sense that there is a substantial longer-term uptick in inflation that is not, in a sense, acknowledged by the Fed would be a little bit of a concern. I think 4 Fed hikes is a likely outcome in 2019. And if you look at the shape of the yield curve, that's pretty much priced in. So that's, in a sense, accompanying a better news story from an economic perspective in the US, and certainly one in which labor is getting, in a sense, a larger slice of the GDP pie. So there's a sort of good news story about developments in the US that at the same time is driving bond yields a little bit higher. But what we also need to bear in mind is there is enormous demand for long-duration assets. That's not just in the US, it's globally. And that has the effect of keeping the long end of the yield curve somewhat dampened, even in the face of Fed hikes at the short end.
Okay, so what will all of this do to the US equity markets, Rick? Because the US markets have entered into their 9th year of a bull run, and clearly there's some worries about a pullback being overdue, perhaps. Do you think this could be that year?
Yeah, this is the paradox in a way. You have, in a sense, better economic news than we've seen for some time from a global perspective, and certainly the US. You've got tax reform, which is a positive and has pushed up analyst earnings estimates for 2018, but that's accompanied by a great deal of anxiety on the part of investors. And I think looking backwards and observing that we've had a 9-year bull run is not a particularly helpful way of evaluating what's going to happen in the next year or two. What we really need to assess is how much earnings growth we're going to see, and is that sustainable? Or are we likely to see the end of the economic cycle and more of a challenging environment for earnings in 18 or 19? And at the moment, we don't see a catalyst for that. So we're actually overweight in US equities within a global balanced portfolio, despite what many say are quite rich valuations. And the reason for that is that we feel confident that the earnings growth story, not just because of tax reform, but because of other factors, will remain in place, certainly in 2018 and into 19. Now, the challenge to that viewpoint is possible inflationary impacts on profit margins. And as I mentioned before, the black cloud, in a sense, of protectionist strategies affecting global trade and therefore rebounding in some way on the US.
Would resources be a part, I mean, when I say resources, I mean commodities, be a part of your investment strategy even now, especially metals, or have they seen their best? At the moment, they are stalling because of the trade war noise.
Yeah, well, commodities fall into many categories. I mean, we often like to have the safe haven of gold, or many safe havens actually in portfolios to provide a little bit more of an anchor. And gold is very unpredictable in terms of price performance in the short term. But what we know is it's got some quite interesting hedging properties for investors from a diversification perspective. So we like to put gold in portfolios from a strategic perspective many times. The other parts of the commodity complex are obviously often pretty pro-cyclical. And so we've got to be a little bit careful about doubling up our exposure to a risk-on type of trade. So at the moment, although we're risk-on, the risk we're taking is predominantly in equities as opposed to credit, or taking more of a position in the commodities from a pure cyclical perspective.
So just getting back to that earlier point where you said that you're overweight on US equity markets, Rick, what does that mean for emerging markets? You think emerging markets could underperform developed markets for the rest of the year?
Well, when we look at our total portfolio, we're actually overweight in US equities. We're also overweight in emerging equities and in Pacific. So Japan is a very interesting market that's undergoing a lot of change. The change fed through to a lot of earnings growth in 2017. It'll be damped in 2018. And in the short term, Japan's been an underperformer, but we feel pretty positive about Japan in the longer term. So where does that leave us elsewhere? We're at benchmark in Europe and in other parts of the world where the risks are pretty balanced. We've got a little bit of a currency risk to earnings in Europe as the euro has strengthened, that offsets some of the kind of domestic improvements we've seen in the European economy. So that could be seen as a little bit of a barbell, being overweight US and overweight emerging markets. But we think we're past the worst in emerging in terms of that, you know, aggregate level of risks. I mean, some of the hotspots like Russia, Brazil, even South Africa from a political perspective may have passed the worst, and therefore we feel comfortable that the valuation ratios that we're seeing in emerging markets in the aggregate are quite attractive.
Okay, in the aggregate attractive. Thank you very much, Rick Lacaille. We got your name right. Thank you very much for joining us and giving us your perspective of how global trends might pan out in 2018. Well, equity markets after opening have remained almost ranged, as it were. Either it's 0.5% down or it is 0.4 down. So not much of movement even at an index level. So let's check out if the commodity markets are giving us any fresh cues. Manisha Gupta is joining us to give us all that. Morning, Manisha, again.
Thank you for that, Lata. Well, red is the color when it comes to commodities. Everything is trading in the negative right now on Friday today. So starting with the crude oil prices, while the markets are looking for a positive demand growth for 2018, they also are looking at very high supplies continuing for the rest of this year as well. So when you look at the non-OPEC output expectations, they are at 1.66 million barrels per day in all of 2018, and that is only expected to increase in 2019, and that is where you have seen that profit taking come in. Apart from that, you you also are looking at the US inventories increase more than what the markets were estimating. And there you have nearly 0.5% decline is what we are working with in the global markets. And we are back below 4,000 rupees for the Indian markets there. The gold and silver prices also are now doing very well. You have seen some strength come back in the US dollar. And ahead of that US Fed meeting in the next week, nobody really is looking to take those long positions in the precious metal sector. Of course, on a longer term, almost everybody would tell you to include this as a part of your portfolio with what's happening in the global markets in sense of politics and financials as well. But at this point in time, we really are trading quite flat to negative. The base metal prices also are taking the same cues home. On one side, it is about the US import tariff and its impact on the prices and demand of the metal. And on the other side, you also are looking at the Chinese coming back as the winter season ends. And from next week, you will see those output curves go away. So there is an expectation that you would see increase in supplies as well. And that's brought all of those prices down by 0.25% to 0.5% on your screens. Trading strategies, we have them from Trends today. They have a buy call coming in for the crude prices. 4,035 is what they're watching there. But they have a sell on the zinc prices with targets at 208 for the day.
Okay, thanks a lot for that, Manisha. Well, that's the update as far as commodities are concerned. But on a quick programming note, Network 18 brings to you its marquee thought leadership initiative, the Rising India Summit, that starts today at 5 p.m. And it is a show that you just cannot afford to miss. The event will be graced with national and international luminaries from the fields of governance, arts, business and academia.
All under one roof. India's Prime Minister, Shri Narendra Modi, Union Minister Rajnath Singh, Road and Transport Minister Nitin Gadkari, Defence Minister Nirmala Sitharaman, Commerce Minister Suresh Prabhu, Finance Secretary Hasmukh Adia, Finance Commission Chairman N.K. Singh and Niti Aayog CEO Amitabh Kant are all going to speak among other bureaucrats and ministers. There will also be a notable voice, Nobel laureate Paul Krugman, who will be delivering the keynote speech for the event. One of the biggest global market voices, Ruchir Sharma of Morgan Stanley, will also be present. And notable personalities such as Anil Agarwal of Vedanta, SBI Chairman Rajneesh Kumar, Nestle Suresh Narayanan, Yes Bank's Rana Kapoor, Chairman of Maruti RC Bhargav, Axis Bank Shikha Sharma, Adani Group's Gautam Adani and Make My Trips Deep Kalra are some of the icons from India Inc. to grace this occasion. Private equity champion Sanjay Nair of KKR and market veteran Madhu Kela will also give their views on the India growth story. So do stay tuned into India's #1 business channel CNBC TV 18 for live coverage of this mega initiative. And as we wind down on Bazaar, here is an exclusive chat. The founder of ICICI Bank, N. Wagul, himself a public sector banker, before he founded ICICI, believes that RBI's hand must be strengthened when it comes to regulating state-run banks. Listening to that very enlightening conversation. Thanks for watching Bazaar. Chartbusters thereafter.
The mess that has been created today in the banking sector is to a large extent owes itself to the fact that the banks have been under the public sector for 50 long years without any improvement whatsoever in their working. And I think Urjit Patel has hit the problem right on its head.
Do you think that we could retain the legislative framework but merely abolish the banking department and go ahead, or do you think the law needs to change?
Yeah, in fact, I would go for a very stronger measure. I mean, you may say that I'm pretty old and I can take a very radical view of this matter. But in 1991, Mr. Narasimham did contemplate the idea that the government's ownership of government's control over the banks are no longer justifiable. If the government's control over the banks are no longer justifiable, I don't see any logic for the banking department to continue to function. I think the Reserve Bank of India should be the sole and only authority in order to supervise and regulate the banks. And I saw today a statement by Bimal Jalan, who said that if public sector banks are privatized, who will lend to agriculture and small-scale industries? I think for 50 long years we have been lending. And private sector banks are also obligated to lend to the priority sector, which consists of agriculture and small-scale industries. That is no longer the problem. The problem today is what Urjit Patel has said, that the duality of control will have to go. And if this You see, ultimately in the PNB fraud, those who perpetrated the fraud, those who facilitated the fraud, those who had knowledge of the fraud or ought to have known the fraud existed,
yes,
will have to be dealt with. But the larger issue of where does it lead us to,
absolutely,
the larger issue of the autonomy of the public sector banks, I mean, that I think will have to be raised to the fore.
Okay.
Instead of merely going on debating as to whom should be blamed for this,
yes,
whether the Reserve Bank of India should have known about this, should have prevented this. Such questions are no longer relevant. I think we should confine our issue that those who are guilty will have to be punished.
Yes.
And move along in it. How are we going to stop such issues from coming up to the fore in the future?
Absolutely.
The only way in which you can stop it is to give that autonomy to the public sector institutions and have the right people there.
So,
and the only persons who can decide who are the right people must be the Reserve Bank of India. It can't be a whole lot of people.
Dr. Urjit Patel makes the same statement. He says public sector banks don't have market discipline. They are not worried that their deposits will be pulled out even if a fraud or a large NPA is created. So would you say, government stake has to come down below 50%? Is that the way out?
These two issues will have to be separated, Lata. One is the control function, another is the ownership function.
Okay.
I think Mr. Narasimhan, I should credit him with this statement 27 years back, that you can segregate these two functions. It does not matter who owns the banks.
Okay.
What matters is who controls the banks.
Okay.
And today, it's not very clear who controls the banks. Is it the central government which is controlling the banks, or it is the Reserve Bank of India which is controlling the banks? Now, while in 27 years back, there is no problem whether the government owns or not. Today, I think it has assumed a further significance because it doesn't make sense for the government to continue to own even 51% or 60% of the banks. Because the government needs money for a whole lot of other purposes. Why should they continue to hold it? If they are going to give up control, I think they can as well give up that ownership. And so that means that amendment to the legislation.